Hello and welcome to Mortgage Watch for Friday, August 22nd. I'm Ilan Awerbuch with Unitrust Mortgage in San Diego. This is news that you can use, financial, real estate, and mortgage. Well, the magic number is 225. 225. No, it's not my IQ. It's definitely not my weight. 225 is the amount of money that Fannie Mae and Freddie Mac need to raise by the end of September. $225 billion is the amount of money that they have in short-term notes that they have to refinance by the end of September to stay liquid. Now you kind of wonder, because Fannie and Freddie basically buy 30-year notes from lenders and investors. They also buy some shorter term. But it's interesting that they're mainly getting their funding in short-term paper. That's a couple of years or less. Very, very interesting. So $225 billion is the amount of notes that they need to refinance. In some recent refinances that they've done, they've been able to get the money they need, but it's been at much higher rates than they've ever paid in the past to borrow money. Of course, that's a sign of what's going on with the two agencies, which we call semi-government. And really everyone is standing by and waiting to see at what point the government steps in and what the government's going to do. Will the government take them over? Will the government give them a cash infusion? Will the government let them borrow money? It's kind of up in the air right now. And of course, the Treasury Secretary, Henry Paulson, it's his job to figure out what they're going to do and what's going to happen and how it's going to have its best effect for the country. Of course, as you know, people around the world buy Fannie and Freddie paper also, and Fannie and Freddie products. Now, this is equity that they're trying to raise, and they have been raising. The $225 billion is a refinance of capital. And, I'm sorry, not capital, but of loans that they have that they need to refinance. Their job, of course, is to buy loans, paper, from lenders and investors, repackage it, and put it out to the marketplace. That's always been their job. The more that they're struggling, the harder it is for people to qualify for home loans. So hopefully there'll be some relief coming in the next month or so from the Treasury Secretary, because that's going to help with the mortgage market. What we're finding is it's harder and harder for people to qualify for loans. Loans of all sorts are becoming more and more stringent than they have been probably ever. So hopefully this is going to happen soon, and the government will either put Fannie and Freddie out of their misery, break them up, do whatever it takes to kind of give them a new lease on life. Some people have called for breaking them up into 10 smaller companies that all do the same thing, which is, again, buy loans, package them, and resell them. So whatever the plan is, we hope it happens soon, because indecision is almost the worst thing that can happen, because the more indecision there is, the more investors are on the sidelines waiting to see what the government's going to do and what action steps it's going to take. Well, as I mentioned, it's getting harder and harder to get loans for paper borrowers. And also rates are slumping because of that, meaning rates are going up. Because as Fannie and Freddie have more and more trouble, more and more time goes into just keeping themselves alive rather than their mission, which is to come up with new and decent products and so on. You may have heard this week that the FDIC, which currently controls and owns IndyMac Federal Bank, is taking steps to modify loans for all IndyMac borrowers that are in any kind of trouble. The head of the FDIC, Sheila Blair, has been touting this program for months, and she's saying that now that they're going to have IndyMac do it, we'll see what happens. They want other banks to follow suit, and that is giving borrowers that are in trouble fixed rate loans, 3, 4, 5, 6%, whatever it is they can afford to keep them in their house. As she's correctly said, it's better to have someone in their house paying 3, 4, 5% interest than for a lender investor to take that property back in foreclosure and have to sell it at 50 or 60 cents on the dollar. It's a lot less problems, and of course, any cash flow is better than losing money on the property. So we'll see how that goes. In a related development, 51 former IndyMac employees sent a letter to the California Attorney General yesterday, which asked him to look into the demise of IndyMac Bank. They're repeating the claim that the comments made by Senator Charles Schumer of New York is what really pushed IndyMac over the cliff. And then IndyMac would have made it, except when he got on national TV and said, IndyMac Bank is about to fail and the feds aren't doing anything. Well, then he kind of wrote the script. People lined up to pull all their money out, which of course wasn't at risk anyway. But without that money in the bank, they were doomed to fail. So they're now asking him to investigate. I'm not sure if a United States Senator can be indicted on charges like this, but it'll be interesting to see how that plays out. In other related news, Standard & Poor's, the rating agencies, is of course seeing that banks are having a tough time, and we'll see where this thing plays out. Every week that we think this thing has kind of been resolved, it seems that there's new news and things going on that take effect and kind of take us into a new dimension. We'll see what dimensions come up for this week. Other than that, we see that apartment loans and interest are starting to be somewhat affected. With all the foreclosures and all the economic trouble spreading, we see that people are starting to not just lose their homes, but needing places to live. So people are doubling up, families are doubling up. There's a lot of things going on where people are acting as if this is a serious recession, which it has been for a long time, although the government's having a hard time calling it that. But we know that it's very, very tough out there, and our hearts go out to people who are struggling in lots of different ways. People are being affected by this, and it continues to worsen slowly. But hopefully the end is in sight. I mean, if the government's going to take concrete steps for Fannie, Freddie, and start to turn the market around, hopefully we'll see things turn around. We know that commodity prices have been dropping steadily, as have been predicted for probably about 6 months. Commodity prices got ridiculously high. The price of oil and the price of gas from that, as well as gold and everything else, have come way down. And even though they've come down a lot, they typically have a lot more to go. Supposedly the real price for a barrel of oil is in the $80 range, and it's still trading in the $114, $115 range. So probably a lot more room to go, and I think that would make everyone very, very happy and make it a lot easier for people to lead their lives, especially as we're coming into a fall season with people in the colder climates needing to heat their homes. That's where we're going to see a lot of real pain and so on, is for people who need to heat their home with heating oil and things like that. So hopefully all these things are going to see some resolution here. That's all the news for this week, Friday, August 22nd. Thank you very much, and we look forward to joining with you next week on Friday. Take care.